Hello, everyone. Today on the Final Bar, I'm talking with Ryan Detrick of the Carson Group. We'll talk to him about some of the charts that tell the story of the big picture evolution of this market, particularly lower volatility. We've talked about how 2023 reminds us a lot more about 21 versus 22 from a volatility perspective. Small caps juiced today to the upside. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets. Using the power of StockCharts, the StockCharts platform was designed to empower online investors in the mid to late 90s to better analyze the markets around them. Over time, we've evolved our site to really empower you to appreciate the lessons of market history, to better understand the market dynamics, the movements underneath the hood, and focus on the evidence the markets provide back to us in the form of price and trend and momentum and breadth and sentiment. We like to touch on as many of those points as we can on a day like today. One of the big things we've been talking about in 2023 has been mega cap leadership, or what we call the narrow leadership, a relatively small number of huge stocks, huge companies that are really driving the lion's share of returns. Day like today, it's small over large in a pretty impressive fashion. The IWM, the Russell 2000 ETF, up pretty well. The small cap S&P 600 up almost 3%. So does this mean an end of that dominance of that area of the market? I don't think it's a little too early to maybe make that declaration, but it does tell you there could be some changing underneath the hood. Also, a really interesting chart showing the rotation into offense away from defense. With that as a setup, let's look at the market recap and see what we can learn about what the charts told us through the course of the day today. As you can see from the little preview chart on your dashboard on StockCharts.com, kind of a choppy session. Certain days are more directional, meaning you have a big upswing or a big down day, and the story of the day is just a trend that tends to persist. Today was more about choppiness. At the end of the day, the S&P finished a little bit higher, but not by much. And it was overall more of a consolidation phase. What's interesting is that certain parts of the market, it's actually a really strong up day. Let's look at the evidence here. The Dow flat from yesterday's close, the S&P 500 up about 0.25% to 4284. The NASDAQ composite up about 0.33%. The real gains happened a little further down. Mid caps up about 2%, small caps down up 2.8%. The only red you see on this front page is the VIX, and I'm going to talk to today's guest, Ryan Detrick, about volatility. The VIX is now just above 14. This is one of the lowest. It is the lowest level we've seen in 2023, and it really gets us firmly back into the range we were in terms of the volatility, the VIX, back in 2021. Think back to 2021. I know that feels like a lifetime ago, but it was a slow and steady uptrend of fairly low volatility. That was a year where we had minimal drawdowns. The deepest pullbacks are about 3 to 5%, and that was about it. So overall, it was all about the strength in the market, and not just strength, but persistent strength, right? Consistent moves to the upside on lower volatility. Let's look elsewhere at some of the other markets. Interest rates overall, not a ton of movement from yesterday. You can see the 10-year yield, 30-year yield, about the same where we were yesterday. 10-year yield still coming in right around 3.7%. Short-term yields obviously well above that, and so we still have that inverted yield curve. But 10-year, 30-year points still around the same levels, 3.7 to 3.9%. The TLT, which we usually use as a proxy for just bond prices, was up 0.6%. The dollar up about 0.33% using the UUP. Over in the commodity space, you can see gold and silver, not too much change from yesterday. Same can be said for the DBC, which is a broader commodity ETF with a little more focus into energy than other areas of the market. But overall, kind of smaller net positive numbers for most of the commodity ETFs that we're tracking here. The crude oil ETF, USO, was down about 0.33%. But other than that, not too bad of a day, not too significant of a move. A lot of movement in crypto land, and you can see that Bitcoin is above 27,000. It's to 27,072. We'll call it up about 5% from yesterday. Ether nearing 1,900, up about 4%. A lot of news flow around cryptocurrencies about regulation. We talked about that yesterday as cryptos were all rolling over. Today, really accelerating back to the upside. You have to expect volatility in this space. I think that's an understood conclusion or an understood risk, the volatility risk of getting in an area of the market like cryptocurrencies, but overall an excessive amount of volatility in that space relative to what we've gotten comfortable with, which is relatively low volatility movements. We'll look at the chart of Bitcoin here in a minute if we have time to do so. Just to finish up in terms of sector movements, top 3 sectors for the day, financials up 1.3%. Not often on the final bar here in 2023 where I've been able to say that when we talk about the 11 sectors. Very rarely have financials been one of the top performers, but the XLF having a nice day. XLY number 2 up basically 1%. Energy number 3 up 0.8%. At the bottom, you have a couple sectors that were down. Healthcare, the worst performer, down 0.8%. A number of names in there. We'll try to look at things like Merck or Boston Scientific. I'll see what we can get to down, 2, 3, 4% through the course of the day. So sort of a give back from, during a choppy period. But healthcare has not been a great place, really pressing the downside today. Staples down about 0.5%. And if you remember what we've talked about in terms of offense over defense, a day like today continuing to accentuate the fact that offense, consumer discretionary, things you want, certainly outperforming staples, things you need, right? More of the defensive side of the consumer space. With that as sort of a starting point to our discussion, let's look at some of the charts that dig a little deeper into these patterns and show us what the context was or what the big picture movements really have been. Here's my main S&P 500 chart. And my initial reaction, again, I love to bring up this chart every morning. It's part of my morning coffee routine. It's the second chart I look at every day. The market trend model is my first one, and this is number 2. And my initial reaction when I've looked at this now for a little while is bullish, right? Just consistently in a nice upswing. Sure, we can talk about the resistance at 4,200, which held for quite some time before the breakout about a week ago. We can talk about 4,300 to 4,325 as a significant resistance level. We're there now. That's that pink shaded area on this chart. I would argue this is sort of the point of no return. We get above that level, that's sort of the line in the sand for the bears. If you're not bulled up by the time we get above there, I think you need to be, right? Because we've now gotten through that last level of resistance. What's left before we get back to the all-time highs around 4,800, really secondary levels from a long time ago that I would argue people are not really too focused on anymore. So I don't know if those levels are particularly relevant. I would say at that point, that's telling you another 10% move to the upside's pretty reasonable, right? That's actually a reasonable follow-through given the trajectory of what we've seen. And this gap that we saw on Friday, which was this gap higher with the strong move, that's when Jay Woods very ably filled in for me on Friday from the NYSE. From there, we really haven't made any much further headway, but overall, we haven't given any of it back either. It's sort of a nice breakout and now holding in a position of strength. So 4,300 to 4,325 remains sort of the level we're watching. We're there now. Question mark is, do we get above these August highs, at which point arguably there's a lot further upside to be had. Overall, though, again, look at the movement over the last 6 to 8 weeks and higher highs, higher lows. This is a trend that is short-term strong, particularly the momentum with the RSI pushing above 60, kind of moving to the upside. Overall, sort of decent follow-through as well. Have to talk about small caps. Now, the chart of the IWM over the last year or two, not a particularly attractive chart. And you think of the chart of the NASDAQ composite, going back to all-time highs. Think of the S&P 500 breaking above 4,200, now testing 4,300, but in a position of strength. Compare that to small caps, which have been a chronic underperformer, and that's really been an issue over the last 3 months, right? Look at the last quarter, and you can see how the relative strength of small caps versus large has really been pushed further to the downside. However, an interesting thing is happening if you look at the chart of the IWM. Number one, it's certainly not going down at the moment. Look at the support that we've seen right around 170. We hit there in December of last year, in March of this year, in May of this year. We continue to find support right around a 170. We're now back above the 200-day moving average. We got around above there around 179. Today, a nice move to the upside with the IWM up about 2.6%. The issue is you have a lot of overhead resistance, right? You go about 10 points above current levels, and we have the August highs, the February highs, all kind of in this 195 to 200 range. I would argue we follow through here, which I think we have. that's your next level of potential resistance. Now, that's a nice move higher above current levels, but it shows you what a different sort of phase that small caps are in versus the rest of the market. Days like this where you see small caps leading, that is really more common in a bull market phase. What's been unusual in 2023 has been the fact that this hasn't been happening, right? Small caps have been underperforming. I am watching very closely the relative strength in small caps, and I would encourage you to do the same. Usually it's a really interesting indication of sort of a risk off versus risk on, which is more what we've seen in the short term. Banks having a decent day, the financial sector moving to the upside. That's not been a common thing that we've experienced, a common occurrence in our trading days. Of course, the chart of Comerica looks like the XLF, the KRE, and a lot of other charts that track banks, regional banks, any sort of stocks in the financial sector. You have that big gap down in sort of the banking crisis of March 23. It's interesting that, you can have banks fail and we may have recovered and can the market be done selling off and digesting those failures? Possibly, right? And the market will tell you if that's the case. From a technical perspective, what can we see? Well, we can see a trend of lower lows from March, April into May, particularly on a closing basis, which is where it's pretty accentuated. And you can see the bullish momentum divergence. Now, that usually is an early warning sign that we're starting to see some improvement, but it's all about the follow through. What's happened over the last week is charts like CMA have gotten back above their 50-day moving average, and it's closed above it this week for the first time since February of 23. You're also seeing a series of higher lows with CMA having a higher low around 35 at the end of May. We're now breaking above the 50-day. We have a nice potential support level around 35, around 8 points below current levels. The 50-day moving average currently just above $40 a share. So do we go further from here? I think certainly possible. I would be looking to see if we can hold the 50-day. In terms of momentum, the RSI is right at 60. And as you may remember, in a bearish trend, the RSI tends to not get much above the 60 level. So we're kind of right at that point where either we continue further, which it seems like an encouraging possibility given the trend we've seen over the last month or so. But let's see if the RSI can get above 60. I would argue that's a question mark. Let's look at some other stocks. Healthcare, one of the worst performers. You can see the Merck going down over the last month or so. You can see potentially a lower high that we may have established today. Today was a rough day with the stock down about 2.7%. It bounced a little bit around the close, but overall down to around $110 a share. That's down from 120, which was the intraday high back there in May. What's interesting is you made a new high in early May. From there, we've rotated lower. We're now below the 50-day moving average, and that is a cause for potential concern. We get back above the 50-day. This is an encouraging chart and sort of maybe a higher low, a buyable pullback. But I'm always, it raises a question mark when we get below the 50-day moving average. That's something to think about for a chart like Merck. BSX kind of in a similar situation. We'll probably have to leave it here, but I just want to show you the fact that we have what's called the dreaded bearish momentum divergence. Higher highs in price, April into May, lower peaks in momentum. We're overbought on that first high. We are not overbought on that second high. That often indicates an exhaustion in an uptrend. You're seeing that on BSX and a number of other names, not just in medical equipment, but elsewhere in the healthcare space. Maybe some potential further downside for that struggling sector. Folks, let's take a quick commercial break. We'll be back with Ryan Detrick of the Carson Group. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a blast to put on this show for you. We appreciate you joining us. And thanks especially to our StockCharts TV team doing a lot of work to make sure we do this show well every day as best as we can. A couple quick announcements before we bring on today's guest, Ryan Detrick. First off, we welcome your feedback on the show, on your host, on our guests, but especially your questions. Our mailbag is fueled from people like you sending in your questions about how do you analyze the markets using the technical analysis toolkit. Email is best. thefinalbar@stockcharts.com is a way to get a hold of us. We're also on Twitter, so tag us in a comment at FinalBarSCTV. And go on YouTube to our StockCharts TV channel. Watch those videos. Put a comment below the video you're watching. We'll gather all those questions. Hope to answer one of your questions live on the air on Friday's show. Upcoming guests, some really good ones. Ryan Detrick is one of the best. I'm excited to talk to him here in a few moments. Adam Turnquist, who's the strategist at LPL Financial, is going to be joining us tomorrow on Wednesday the 7th. On Thursday the 8th, we have Willie Delwich, who just recently launched his own firm called High Mount Research. We'll get his take, big picture on this market environment. Next Tuesday, helping us get ready for the Fed meeting, we have Gina Martin Adams, who's the chief strategist at Bloomberg Intelligence in New York. I want to welcome on today's guest, Ryan Detrick. Ryan's the Chief Market Strategist at the Carson Group, coming to us from Charlotte, North Carolina. Ryan, good to see you. How are you?
Dave, I'm doing well. I just drove 100 miles an hour to get here. You and I were talking in my car, but I sprinted inside and I'm here. And as a lifelong Cincinnati Reds fan, just so people know this, the number one prospect in baseball, Ella De La Cruz, was just called up. He's starting tonight for the Reds. I bought tickets 15 minutes before that news, so we were going anyway. So my boys are on cloud nine. As a Reds fan, you always like the stock market, look forward to the future. De La Cruz looks like the real deal. We'll find out tonight.
Good for you. Way to get a Reds pitch in there. That's impressive, Ryan, as always. Let's get to the charts if we could. You brought a couple charts with you. We'll start with volatility, right? What's interesting about the volatility conditions in 2023, incredibly low relative to what we've seen in previous years, and it feels a lot more like 2021. What do you make of the VIX going so low this year?
Yeah, I mean, that's what we're hearing, right? The VIX is 15, 16. It's so low. And yes, we all just went through a period for years of higher volatility. I like to take these big cycle looks at things. That's kind of what we're showing here. I guess we're back to almost 1990 on the VIX. Dave, as you know, and a lot of listeners might know this, the VIX can stay beneath 20 for a long time, right? The VIX averages like 20, but there's no such thing as average when it comes to the stock market. You can have years well above 20, years well below 20. Our take is this. This is maybe another building block into this bull market we think we're in. I've come on here for a while, so we think stocks are going higher. We got some weird looks. We were saying that, this time 6 months ago. But I think this is another sign that, listen, the volatility index of 15 feels low, but it might not be as low as you think. Because look at history. It can stay low for a long time. And honestly, Dave, that's what we think is probably going to be the case here. Just lower volatility, which tends to mean a higher stock market. So we're not complaining.
I was going to say, right, that traditional relationship is you have stocks going higher, you have volatility low. That's sort of the classic bull market phase. We just haven't seen that in quite some time, right? 2022 certainly felt very different. Now we're getting a little more of that sort of vibe, which is pretty impressive. Let's get to your second chart. I want to talk about the global index, the DJW. What does this tell us about the conditions?
Yeah, I mean, I guess the bottom line is we hear about these 5 stocks going higher, right? Only 5 stocks going higher. But you look at like the Dow Jones global indices here, it's breaking above at a 52-week high. And you've got potentially, I've got a CMT. Yes, I'm more of a cocktail napkin, I think, type of strategist. I think we're pulling it up there, maybe. Yeah, there we go. But potentially a head and shoulders bottom, right? 52-week high in the Dow Jones global index. I just think it's hard to say only 5 stocks going up. I know small caps had a really good day again today. They had a great day on Friday. I think it's just another way of showing there are a lot of opportunities globally, but also there's a lot of stocks participating more than just 5, in our opinion. And that's just another neat chart to show it.
It's amazing how many of these charts were facing huge resistance levels. I know at the S&P at 4,200, other indexes as well. The question was, can we get through those resistance levels? It certainly appears to have happened, right? And we're seeing that with the Dow Jones Global Index, among others, breaking to a new swing high here. To get to your last chart, let's talk about this one. There's actually some really interesting work talking about the gains we've seen off of the lows. What does this tell us about where we've come from and where we might be headed next?
Yeah, and I don't make these rules up. I think maybe the media does, Dave. But a new bull market, that's up 20% from the October lows. I don't think we quite made it today, but we are we're a couple inches away from being in a new bull market because, as we all know, down 20 is a bear market. But I took a look at what does it mean when you're up 20% off the lows, and that's what this shows here. Guys, 13 times we've had a 20% bounce off of a major 52-week low, bear market low. 1 year later, higher 12 times, up 17.7% on average. Yeah, there it is, 17.7% average a year later. And 3 times, yes, you did violate the previous lows, so you made new lows. It happened twice in a tech bubble and once in financial crisis. The other 10 times you gained 20% or more off those lows, you didn't break the lows. In this case, that'd be the October lows. We've been saying for a while October lows were it. Dave, I think it's just another building block that suggests, again, don't fight the trend, right? I mean, the trend is higher, and I've laid a lot of these types of these studies out there the last 6 months that they're saying stocks are probably going to go higher. This one further confirms it in our view. At the Carson investment research team, we moved overweight equities late December. And believe me, we got some weird looks. We are still overweight equities. We like small caps, industrials, financials, and energy the rest of this year as we think things broaden out. That's how we're managing the money we run for our Carson advisors.
Let's dig into that a little bit more. I really appreciate you sharing some of those charts here. The story of 2023 to date has been narrow leadership, right? It's been a relatively small number of huge companies doing all those gains, Apple, Microsoft, et cetera, et cetera. Are you seeing a bit of a pivot here? We're seeing this week and then over the last week or two, things like financials, things like energy, having decent days. Is that the beginning of more of a rotation to some of those lagging sectors?
We think it is, and I know this is live. I'm going to use the F word, Dave. Fundamentals. I know we're technicians on this, but look at the fundamentals. I mean, we're not in a recession. We've been saying this for a while. I'm a macro guy, so I like to look at things. We don't see a recession when we look at the data. The consumer is too strong. What does that tell us? On Friday, good news was good news, right? We're getting some good news on the economy. No recession coming. Those cyclical areas, some of those other areas, we think things will broaden out the second half of this year. Just like we said, yeah, only five. Well, that's not true. Only 5 stocks led, but you had to be in communications and tech. We get it, but we think the second half of this year is going to be a lot more opportunity. And just another step of this bull market as that baton gets passed around.
We have the Fed meeting come up. I'd love to get your take, Ryan, in terms of how you think about the Fed decision. I feel like day to day, there's a lot of fluidity in terms of what the expectations might be. Given, on any given week, it's an obvious they're going to raise another 25 basis points. It's obvious they're not going to. Where do you sort of have a sense of where we're at in terms of this trajectory of rate hikes and what that means for some of those leadership trends we've observed?
Yeah, there was another F word, right? The Fed. I mean, I'll tell you, it's funny. We hear about a different Fed governor every week in the news. I didn't even know they existed. Everyone's always, what did this person say? What did that person say? Truth again, inflation's becoming back. We think the Fed is done. I know they're going to probably take a pause here, maybe one more hike in 6 weeks. We don't buy that. We think the Fed is likely done. I mean, it takes like 12 months for all these hikes to really get in the system. So there's still a lot of medicine coming, Dave. And just leave you on this. I took a look going back like 3-4 decades. The last 10 times the Fed stopped hiking after a series of hikes. 1 year later, stock market higher 8 times, up about 14% on average. Yes, there's 81 in there. Yes, there's 2,000 in there. They stopped hiking. It wasn't a great time to invest in stocks. Just because the Fed stops hiking, that's not bad. Where you got to worry is when they start cutting. And we just don't see any cuts anytime soon with the economy led by a strong consumer.
Yeah, it's amazing how cuts were a foregone conclusion, I feel like, not too long ago. Now it seems pretty clear that it doesn't. And you're right that the data on inflation, they mentioned they were data dependent. It certainly seems to be that there's more and more data kind of coming in. When you think about the 10-year yield, we've talked about the yield curve and interest rates. 10-year yield currently around 3.7%. Overall, what is your take on what the 10-year yield goes from here? And does that impact things like the financial sector, which have certainly been struggling so much on a relative basis year to date?
Yeah, I mean, I tell you, I look at things, the commodities, right? Various commodities, copper gold ratios, and you think maybe the 10-year is going to have trouble going much higher from here. We are underweight fixed income bonds in the portfolios that we run. We like stocks a little bit more. So you could say, is that bad, quote unquote, for financials? I don't know if it's bad necessarily, but a weaker yield might not be the best thing for financials, but it's okay for bonds. And what do we have last year, right? Stocks down 20%, the treasuries down like 18 or 19%, the worst year for a 60-40 portfolio ever. Well, we get a little lower yields and bonds do okay, but stocks still do fine. That's kind of how we see it potentially playing out there.
When you're looking at the S&P 500, and I appreciate you allowing me to kind of go anywhere and everywhere, Ryan. I knew you would be able to handle some random questions and thoughts. So certainly the amount of bullish evidence has started to mount, right? And I think one of the big issues we've had has been a lack of breadth support, but you're now starting to see that a little bit, particularly, measures that have been, like advanced decline data starting to turn higher a little bit. When you're looking at a chart of the S&P 500, what would the bear case look like from here? And I guess another way to ask that question, what might tell you that the bullish positioning is incorrect? Is there a signal or a movement? Is it a rotation lower in some of those leadership spaces like mega cap tech or communications that would tell you that things are starting to be a little softer than you might expect?
Yeah, I think relative strength charts, kind of hard to say, relative strength charts on things like your utilities, right, which have been weak, on real estate, which has been weak, staples, which has been weak. The weak stuff has been lagging. That's fine with me because, again, we like those other areas. If we start to see some more leadership from there, that's something that would worry me. Also, the 4,200 level, right? 2 weeks in a row, we've closed above that 4,200 level. If we have a false breakout or something, which we saw, August, last summer, we popped above for like a minute, cup of coffee, and came back lower. But if we do break beneath 4,200, that'd be near-term concern. But just more leadership from those defensive areas, which fortunately, Dave, we're not seeing. Also, I love looking at credit spreads, right? I mean, I've said a while, credit spreads, smartest guys in the room. Credit markets, there's not a lot of stress in credit markets. Look at what construction's going on. Look at manufacturing construction going on. You know who does that? Small regional banks give those loans to those companies. We are seeing an explosion in manufacturing construction over the past 6 months or so. That doesn't feel recessionary. That doesn't seem like this big credit explosion we've been hearing about in the media for the last since March, I guess. So I'm not seeing those things. So until I see that, I still think equities are the way to go, led by those cyclicals and small caps.
It's amazing how this market, I feel like, has shifted. You're seeing some more and more signs of encouragement. Really appreciate you, Ryan, talking through some of these different items and sharing some charts with us. Be well, stay safe. Thanks so much for getting back home in time to do the interview, and we'll talk to you again soon, Ryan.
Real fast. I did see a cop. I was going probably 80, and I saw a cop like 3 miles from my house. Like, you've got to be kidding me. Fortunately, I didn't get a ticket, and I made it to the show, Dave. So thanks for having me.
Timing is everything, Ryan. You did it. Well done, as always. That's Ryan Detrick, Chief Market Strategist at Carson Group, coming to us from Charlotte, North Carolina. What I love about Ryan is, besides the fact that he's just a genuinely nice human being, one of the good guys in the industry, I would argue, is the fact that his discipline really thinks about all the interplay of these different inputs, right? Thinking about the Fed, thinking about the trends, the breadth, really the general holistic approach that we try to advocate on the Final Bar and really on StockCharts is thinking about how the technical inputs and the trends and the analysis of price should relate to overall your analysis of the economic conditions and potential for growth. Great take there, as always, by Ryan Detrick of the Carson Group. By the way, Ryan has a really good podcast if you've not listened to it. I think it's called Facts versus Feelings. Really well done. So check it out on Spotify, Apple, wherever you do the podcast thing. We've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We mentioned offense over defense, and what I love, I asked Ryan about, what would maybe tell you that things are getting a little softer than you might expect, and he pointed out improvement in some of the defensive sectors, things like utilities and real estate. One of our favorite ways of measuring offense over defense came from, the Fidelity chart room years ago. One of my predecessors at Fidelity, Bill Doan, had a hand-drawn chart called offense versus defense, and it was using a series of indicators which were no longer available. So what I did was take that and try to modernize it, use some ETFs to recreate the essence of what Bill and his team were trying to do back in the 1960s and 70s, and basically looked at the XLY versus the XLP. This is the cap-weighted version in the top half of the chart. This is the equal-weighted version in the bottom half of the chart. Both of these are rotating higher. The cap-weighted version, I'm always a little more skeptical about because this is really a lion's share of this line is based on Amazon and Tesla and Home Depot. They're about 50+% of the nominator. So if they go higher, this ratio is probably going to move to the upside. The equal-weighted version turning higher over the last 6 weeks, I think, is maybe one of the more encouraging things that I could identify for you in terms of recognizing the strength that we're seeing emerge in offense over defense. And part of this is stocks in the XLY doing well, but I would say it's much more about things like Coke and Pepsi and PG and other leadership names within the consumer staples sector that have now softened up quite a bit here. That's more offensive than defensive at the moment. Chart number 2, regional banks. Regional banks have had this bullish momentum divergence. A number of the individual stocks that make up the KRE are having a similar pattern. It's a weird chart because of the significant drawdown that you saw in March. And from there, we continued lower in April, really mostly in early May. From there, though, we made a low that so far has been the low. We've made a higher low in around $36 in mid-May, another higher low at the end of May, early June, and now we're rotating higher once again. We are back above the 50-day moving average this week, and I'm very curious to see if the RSI continues to improve from here. I am interested in the fact that regional banks, which have been one of the worst performing groups in 2023, starting to rotate higher. Does the relative strength at the bottom of this chart really improve further from here? Finally, T-Mobile. I love to highlight charts that are just classic breakdown charts because while William O'Neill passed away not too long ago, he was a genius at looking at the lessons of market history, focusing on what the charts told you or could have told you. What did you miss in the chart that could have told you something was wrong? And I often joke with other technical analysts, the charts tell you something's a problem a lot earlier often than the fundamental data confirms that that's an issue. Look at what happened with T-Mobile, breaking below the 200-day, testing it from below, continuing lower, now in a clear pattern of lower highs and lower lows. The momentum is weak, nearing the oversold condition. The relative strength is negative. This is a chart in a downfall. Avoid charts going down. Folks, that's a wrap for the show. Special thank you to Ryan Detrick Detrick of the Carson Group joining us remotely for StockCharts.com in Redmond, Washington. I'm Dave Keller. Have a good night.